presentation here. It's going to be called The Emerging Role of Crowdfunding in Commercial Real Estate Investing. Then we're going to be getting a company at 2:20 p.m. Eastern Time. We're going to be getting a company called Gaucho Group. Their ticker is Vino. I believe they are in the real estate space in like vineyards and stuff. Kind of cool. And then this one I am pretty excited about. At 2:40, we're going to be getting an educational segment here. It is going to be with Sylvia Belrack, technical analysis for reopening stocks. That's going to be pretty cool. And then one that I know some chatters in our YouTube are excited about, Grom, that's ticker GROM, is going to be coming up at 3:20. That is in about in an hour and a half. So that is, again, one that people are pretty excited about. For you have to stick around for that one. And let me click over to my doc here. We are ready with, it looks like Aaron's ready. Aaron Halfacre. There he is.
Hey.
How you doing, Aaron?
I'm well, Brian. How are you?
I am doing awesome, sir. And you're from Modiv, right?
You're
going to be telling us about crowdfunding and commercial real estate investing. Sounds pretty interesting. I'm going to let you have at it, sir. Okay?
Sure, absolutely. So we have a presentation. I don't know if it's up for everyone to see.
Oh, I saw it. And then there it is.
There
cool.
we go.
There you go.
If you could flip it to the first slide there of history of crowdfunding. So, so crowdfunding, we've all heard of it. My goal today is to talk a little bit about it, how it applies to real estate investing, and how, as active investors, there's a way for them to figure out a way to be exposed to it and participate in what I believe is sort of an evolutionary change. As I mentioned before, we've all heard of crowdfunding. The actual first modern form of crowdfunding actually came about in 1997. It was a British rock band named Marillion went online and raised $60,000 to allow them to do a tour. From there, we've had various forms of crowdfunding formed. The first term use of it in the media was in 2006. The crowdfunding that we'll be talking about mainly today, and what's applicable to people who are looking to get a return on their capital, is the crowdfunding that was derived from the Jobs Act. The Jobs Act came out in legislation in 2012, and it officially formed what is now known as today's asset-based crowdfunding. There are over 1,500 crowdfunding companies out there, United States, Europe, Asia. So it's really gaining traction. And I'd say, as it relates to real estate crowdfunding, which is probably the biggest in terms of assets deployed, we're less than 10 years into the industry. We're already seeing over $1 billion of annual transaction volume. So it's quite significant in that regard. Now, if you go to the next slide and kind of break down what crowdfunding is, there's effectively two types of crowdfunding. There's the rewards-based that we all know about. Rewards-based crowdfunding. That's GoFundMe, that's Patreon, that's Kickstarter, that's Indiegogo. These are classic examples of the rewards-based. And what that means is that you can crowdfund entities. You can crowdfund a new product idea. You can crowdfund a charitable cause. You could crowdfund, maybe a YouTuber that you really like on Patreon or something like that. What you're doing, though, is you're giving economic funding. You're not getting economic reward. You're getting maybe a product, a new, a launch up. You're getting the goodwill associated with a charitable event. It's not designed as an investment necessarily. Now, those crowdfunding companies that I mentioned, Indiegogo and things like that, they are making money. They're charging, fees associated to match sort of crowd sponsors with people's money. But it's different than the asset-based crowdfunding. Asset-based crowdfunding is designed specifically for you to make an investment and get a return on that investment. And that's where, under the Jobs Act, that we've really come about. And I know you mentioned that you're going to have the Vino on here a little bit later on. It's actually a pretty wide spectrum. You obviously have businesses. So these are under the Reg CF model typically. So these are startup businesses. And what you're doing when you invest in them, you're getting a stake in their equity. These are sort of startup companies that tend to be very small. They tend to have gone not the route of venture capital, but they're looking to go through Start Engine or Our Crowd or AngelList. And they can be debt or equity, but typically it's equity and it's under a certain regulatory scheme. You also have, like you mentioned, wine. I've seen whiskey bonds out there. There's certainly art, sports memorabilia, automobiles. There's a lot of things that, if it's an asset and someone thinks they can buy at a certain price and sell it later, and therefore there's a return or there's a way to make income off of it, it can be packaged as an investment vehicle. And that's what you see crowdfunding. Real estate crowdfunding, though, is probably the most prevalent. And real estate crowdfunding is a bit of a misnomer, right? So if you go think about real estate, it's been around. Real estate investing has been around for centuries, and typically these investments are very large, right? So if you go back in time, the Statue of Liberty, we had to build a foundation for the Statue of Liberty because it was a gift coming from France, and so the sponsors at the time crowdfunded from a various amount of investors to put in small sums of money so they could build that star-shaped foundation of for the Statue of Liberty, the base. We've been crowdfunding real estate assets for a long time, but now we're doing it with technology, and it really allows people to invest in what are large assets they wouldn't get access to normally through sort of an online platform. There are basically three sort of categories of real estate crowdfunding. There's a single asset LLC. So if you go to someone like CrowdStreet or Real Crowd, you're going to see an individual, what I call the Monopoly card picture. You're going to see someone's like, oh, there's an apartment building. It's going to give me this IRR and this potential cash return, and I'm going to invest in this, and then I'll look back 5 years and we'll see if it worked out. Right. So these are illiquid traditional real estate investments where you're putting them in and you're setting aside your money and you're getting what is called a K1. If you're not familiar with that, it's not a 1099. So it's not like you get from a Schwab or a Vanguard or something like that, but it is a K1 that your accountant or you will have to incorporate into your tax return. It's closed end, meaning that it's not you invest in during the window and then it's closed, and that window stays closed until they have sold the asset. So the liquidity is only guaranteed upon, or not guaranteed at all, but it's only available when the asset is sold. And the strategies tend to be high leverage strategies, fix and flip strategies. Sometimes they're development strategies, but they're higher octane, and therefore they're giving you higher potential returns. Blind pool funds are sort of the new starting phase. So if you have a fund and it's not just a single asset, but you have a strategy, like you say, we're going to go out buy apartments, and you open a fund, the fund doesn't actually have any apartments on day one. But the strategy is, look, based on our track record, we can go do this, and so therefore we're going to invest and put your money in. That's a blind pool. Those tend to be K1s as well, not universally, but generally speaking. And the liquidity on that can be limited. Sometimes they offer sort of either annual windows or periodic windows, but typically it's a strategy where we buy the assets, we fix them up, we sell the assets, you get your money. The last category is REITs, and a lot of the people listening today are very familiar with REITs, the publicly traded kind. The REIT actually is an IRS election. It just means that you avoid double taxation. So if you think about Realty Income, which is ticker O, it is a publicly traded REIT, and you compare and contrast that to say IBM, which is also a publicly traded company. At IBM, the income is taxed at the corporate level, and then when IBM sends out a dividend, it's taxed again at your personal level. A REIT status basically is an IRS election that a company can make, and it avoids the taxation at the corporate level. So it passes through over 90% of its taxable income to the investors, and it's only taxed at the personal level. So it reduces the tax drag, and it's designed specifically for holding real estate assets. REITs can be publicly traded, they can be public non-traded, and they can be true private REITs. When I worked at BlackRock for over a decade, we would structure REITs, and they would be invested in by CalPERS and CalSTRS and other institutional people with no intention of them ever being listed or have to do any public filings. Modiv, as an example, is a publicly filed company. So we file Qs and Ks just like Realty Income does, but presently we're not traded. We look to probably list sometime in the next 18 to 24 months, and then we would be traded just like everyone else. So those are the three primary vehicles that you can find real estate crowdfunding invested in. If you drop to the next slide, you'll see there is really sort of how the business models works. So you can get into the different types of vehicles, so REIT or blind pool or single asset, but there's different types of real estate crowdfunding companies out there. Just like there are different types of investment vehicle choices you can make. You can go to Robinhood, you can go to Acorns, you can go to Schwab, you can go to Fidelity. The list goes on and on. Just like there are different purveyors of securities in sort of the traditional world, there's different purveyors of securities in the real estate crowdfunding space. The syndicators, the ones I mentioned, where you look at that single asset vehicle, where it's just in one apartment building or one office building, those are going to be sold typically through syndicators. Think of syndicators as brokers. They are basically creating a two-sided marketplace where they're spending advertising dollars and marketing dollars to find sponsors who have properties and investors who want to invest in them, and they match them on their site. This is not unlike what you saw on Indiegogo or Kickstarter, where they're matching people who want to contribute money with people who want that money. Those models are transaction driven, right? So you have to keep continuously sort of doing deals to generate revenue. Those CrowdStreet and Real Crowd are the two biggest examples of that type of model thing. And so what they do is effectively match people, but to own that, to participate in their volume, and they've had great success, by the way, you'd have to own CrowdStreet. And unfortunately, right now, CrowdStreet's not available to own. On the other end of the spectrum is called asset aggregators. And asset aggregators, Modiv is one of those, Fundrise is another one of those. We actually buy the assets. We own title to those assets. We manage those assets. Modiv happens to be a REIT that's, like, as I mentioned, publicly filing, but not yet listed. And the management team is a part of Modiv. Fundrise is a similar model, but it has a bunch of smaller REITs and they're externally managed. So the fees are paying someone else. In that context, you're raising assets, not unlike a mutual fund company. You're growing the assets and you're getting revenue associated with the assets you're managing, and you're building sort of technology value. And then there's versions in between that Equity Multiple, Realty Mogul do, which is a blend of those two different types of models. If we go to the next slide, how do we think crowdfunding is really going to evolve? Where does it go? Look, it's gaining awareness now. As I mentioned, there's over $1 billion of annual transaction volume in real estate. I see tremendous parallels with traditional financial services companies. So if you go back in time, and if you relate the Jobs Act of 2012 to the May Day Act of 1975. So those who don't know, on May 1st of 1975, the US government deregulated stock trading commissions. Back in the day, they were regulated, just like our phones were regulated by AT&T and our airlines were regulated. They deregulated these, and so that now you could start lowering or raising, in certain instances, the cost to trade stocks. Charles Schwab, the day after that came out, formed Charles Schwab, the brokerage company, and he started leading with discount brokerage. If you think about over time, there was a lot of other ones. There was Scottrade, there was Ameritrade, there was Trade Plus, there was Interactive Brokers, there's JB Brown. There's been a ton of them from the late 70s, early 80s, even into the 90s and early 2000s. We had a lot of forms of discount brokerage. They eventually got mainstream, they got bigger, and then they started consolidating, and then some of them went public, right? Today, we see that Charles Schwab and Morgan Stanley, basically acquired up all the other historical discount brokers. And on the other side of the spectrum, you have mutual fund companies. You have Vanguard and Fidelity and Eaton Vance, who were like asset aggregators in the real estate crowdfunding side. They were just growing, they're growing assets. But if you think about modern day financial services, Charles Schwab provides discount trading, but it also has mutual funds. Vanguard has mutual funds, but also discount trading. And so they've kind of converged and merged into one, and they've become industry giants. Morgan Stanley is an example, not only bought discount brokerage operations, but they also bought mutual fund operations, and they do both as well. And so this parallel where we see where companies start, there's a new regulatory change, there's a lot of different entrants come in, they start to get scale, typically through M&A, and then they start to list. And then from there, they become very large and profitable. We see that same parallel happening in real estate crowdfunding, where the sizes are now getting such that we'll see more M&A. Modiv has participated in several instances of M&A. We've acquired several companies. We'll look to acquire more. And then eventually you'll see listings. As I mentioned, for instance, we look to list probably in the next 18 to 24 months. And as this evolution grows, we think that real estate as a form of asset investing, it should be just as prevalent and just as user-friendly as it is with our stocks, right? So now the idea of having no commissions for stocks is a widely accepted practice. It wasn't 20 years ago. Getting to the point where you can own real estate without having to pay a lot of fees should be the same point in time that we have. We certainly want to see that achieved over time. I think there are important considerations, and if you go to the next slide, it kind of highlights them. If you're going to invest in crowdfunding, you're going to invest in these real estate deals, you need to think about fees, right? So the real estate space is still a bit of the Wild West. And some of the sponsors will charge fees that you would never pay if you're going to Schwab or Vanguard or wherever. You just don't think about paying them when you're buying stocks or mutual funds. You shouldn't have to pay for them in the real estate space. So pay attention to fees. Modiv, the way we're organized, we don't actually charge those fees. We're just like a publicly traded company in the sense that we have G&A and we have the normal expenses associated with it, but we're not charging other fees. That means that they can make money when you can't. Corporate governance is important, right? If everyone, when we're buying stocks, we're used to having ISS or certain sort of public watchdogs, and we're used to having a board of directors, and you're used to having all these sort of corporate governance features that are designed to protect investors. It's important to see those in real estate as well. Some of them have them, like for instance, Modiv obviously does have them. Some other companies do too, but a lot of them don't. They don't have any corporate governance, so there's not any body out there with a fiduciary duty for you as the investor. And so that's an important thing to think about. And the last thing I think about, as this is true of any type of investing, is got to be risk aware, and you got to make sure that those people can manage risk. It doesn't mean be risk averse. It means be aware of the risk you're taking and make sure you have the skills or the people that you're giving your money to. If it's running a company, if you're at Apple, you want to make sure that they understand the risk of new product launches and the risk of managing logistics, and they have the skills to do it. So you don't mind that risk, and so you do it. But there are other companies who fail to get their products off the ground, or they fail to get the supply chain logistics worked out, and so they fail to supply the companies that they did get off the ground. And so managing risk in real estate is no different than managing risk in the stocks that we buy or the mutual funds we buy. As you think about a mutual fund company or a sponsor, you want to make sure that portfolio manager knows how to pick the right stocks and knows how to manage them. Same with real estate. You want to make sure that the team has experience and know how to buy the real estate, manage the real estate, and create value for you. The value proposition is both growth in the share price, and income. Real estate, obviously, particularly REITs, are designed for income. So it allows you to accomplish two goals. By way of example, Modiv it doesn't publicly trade right now, but every quarter it gets valued independently by Cushman & Wakefield, and it provides appraisals of the assets. Based on the appraisal value of our real estate assets, that's gone up 13% year to date and 24% in the last 15 months. So it continues to grow, and that's just reflective of the demand for real estate. I think the last point I'd make here is that owning real estate is fine. If you want to also own the crowdfunding company, you need to find a company that has access to both. You need to be able to buy the crowdfunding platform, and so participate in that financial services trend that I just elaborated on, as well as get the hard assets of real estate. Modiv is an example where everything is combined. So if you buy shares in Modiv, you're getting not only the real estate, which is long-term net leases, to creditworthy tenants, but you're also owning the fintech crowdfunding platform. In other instances, like for, say, Fundrise, you might be able to buy shares in the crowdfunding platform, or you could buy the individual REITs, but they're not together. And obviously, from our perspective, we think the alignment of interest and corporate governance are the better features because they're just what we're used to in the publicly traded stock market.
Here I am, Aaron. Awesome. Thank you for that quick presentation. That went by really fast. I think that's a good thing, right? One quick question for you here. So, you were saying it's going to be a year and a half to 2 years before you guys are public. What are some ways that investors right now can gain exposure to crowdfunding in real estate? And if maybe it's a segment of the market that you want to mention, or maybe it's like some specific companies. I don't know.
Yeah. So uniquely though, there are not any publicly traded crowdfunding companies
right
there yet.
Right.
I think the way to get them is what I'd call sort of pre-IPO, so pre-listing, right?
Okay.
If you, from time to time, like I know historically that CrowdStreet and Fundrise have made shares available in their manager. So their manager is this entity that is the crowdfunding technology. Occasionally they've made them. They're illiquid, they're private placements. They're usually relegated to accredited investors only. Modiv is unique. Modiv it owns both the crowdfunding platform and the real estate. Our shares are available to anyone, sort of accredited, non-accredited alike, but they're not traded, right? So to someone buying into them has to accept a degree of planning to get them to be listed. We do provide liquidity, so on a monthly basis, people can redeem their shares. So it's not a roach motel, but it is not. Real estate in itself is not inherently liquid, so it takes a little bit of time to generate cash, and so that's why we're endeavoring to go list. We could list sooner theoretically. We don't want to overpromise and deliver. Sure. But I think the right way to own it is making sure you have the vehicle and it has all the bells and whistles, right? Because if you think about being a private company and going to public company, there's so many steps and evolutions and experience that someone needs to have. They need to know how to get their financial reporting done right? We're used to seeing Qs and Ks out there for publicly traded companies, but a lot of people don't know how to do that, or they're not set up for it. And then how to manage it, right? Just manage doing earnings call. For instance, we just had our earnings call yesterday. We run an earnings call, even though we're not publicly traded. We run an earnings call just like I did
Good
when
practice.
I took a public and when I took a company private.
Right. Right. Well, maybe Motive will be the first publicly traded crowdfunding company.
It may be, and
Good
I think
luck with that.
yeah, and the way we're designed is, if we'll seek to do consolidation. If we're able to consolidate, great. If
Great.
someone else in the industry comes in and says, "Look, we love crowdfunding, and it's an institutional player, and they're going to go in," we're probably also at risk of being consolidated.
Right.
And
Right.
that just means that if we're the better vehicle, and we can afford investors a premium return, then that's where the capital will go.
Gotcha, gotcha. And Aaron, you're gonna be back with us a little bit later today, right? There's gonna be another interview. I see the title here. Where does real estate fit into the post-pandemic portfolio? That's
Yeah,
kind of a
looking
cool
forward to
little
talking a little bit
discussion.
about that and answering questions.
Cool. Well, then when that's at 3:40 p.m. You'll jump on here with Luke, and we'll see you a little bit later, Aaron.
Thank you, sir. Enjoyed
Yes,
it.
sir. All right, later.
Bye.